Today's world, many people are drawn to the excitement of chasing hot stocks. They hope for quick wealth, jumping from one opportunity to the next, always searching for the next big winner. This approach is fast-paced and often stressful, filled with ups and downs as investors try to predict which company will soar. But beneath this noisy pursuit lies a quieter, more reliable strategy that doesn't make headlines but often wins over time. Let's explore why index funds offer a different path, one that's built on patience and consistency rather than speculation. Imagine two investors. The first is always buying and selling, trying to catch the next big winner. Their days are filled with research, predictions, and constant action. The second investor, however, makes a simple choice. They invest in an index fund and stick with it. Over the years, while the first investor works tirelessly, the second does far less. Yet surprisingly, the second investor often comes out ahead, proving that sometimes less is more in the world of investing. Index fund is a type of investment that doesn't try to pick winners. Instead, it owns a small piece of many companies in the market. This means your money is spread across giants like Apple and Amazon, as well as hundreds of other businesses. By following the entire market, index funds avoid the risks of betting on a single outcome. This simple approach is powerful, offering broad exposure and reducing the chance that any one company's failure will hurt your investment. By owning a slice of many companies, index funds spread risk. If one company struggles, the impact is softened by the success of others. This diversification is a key reason why index funds are so effective. Instead of relying on a single company to perform well, you participate in the overall growth of the market. This approach helps protect your investment from unexpected downturns and keeps your portfolio balanced. Markets are unpredictable. Even professional investors struggle to consistently beat them. The ups and downs can be sudden and surprising, making it difficult to know which stocks will succeed. Index funds accept this reality. Instead of trying to predict the future, they focus on participating in the market as a whole. This shift from prediction to participation is what makes index funds so resilient. Strength of index funds comes from three simple principles: time, diversification, and discipline. Time allows your money to grow through compounding, turning small investments into larger sums over the years. Diversification reduces the risk of any single company failing. Discipline keeps you from making emotional mistakes, like panic selling during market downturns or chasing after quick gains. Together, these principles create a foundation for steady, reliable growth. Compounding is the process where your money earns returns, and those returns then earn more returns. Over time, this snowball effect can turn modest investments into significant wealth. Index funds, by staying invested and letting time do its work, harness the power of compounding. This is why patience is so important. Growth may seem slow at first, but it accelerates as the years go by. Diversification means spreading your investment across many companies and industries. This reduces the risk that any single company's failure will significantly impact your portfolio. Index funds automatically diversify, giving you exposure to a wide range of businesses. This built-in protection is one of the main reasons index funds are favored by both beginners and experienced investors. Discipline is about sticking to your plan even when markets get turbulent. Emotional decisions like panic selling or chasing hot stocks can lead to costly mistakes. Index funds encourage discipline by removing the temptation to constantly trade. Investors who stay consistent and avoid emotional reactions often see better results over time. Markets rise and fall. There are crashes, recoveries, and booms. These cycles can be unsettling, but they are a normal part of investing. Index fund investors accept these ups and downs, knowing that over decades the market tends to grow. By staying invested through all cycles, they benefit from the market's long-term upward trend. Consistency is the secret to index fund success. Investors who stick with their plan regardless of market conditions often see steady growth. This approach may not feel exciting, but it's proven to work. By avoiding the urge to react to every market movement, consistent investors build wealth slowly and surely. Emotions can cloud judgment. Fear and greed drive many investors to make poor decisions, like selling during a crash or buying during a boom. Index funds remove much of this emotion by offering a simple, steady approach. Investors who follow this path avoid the pitfalls of emotional investing and stay focused on their long-term goals. Index investing doesn't feel exciting. It's slow, steady, and ordinary, but that's exactly why it works. By removing emotion and replacing it with consistency, index funds help investors avoid costly mistakes and build wealth over time. The ordinary nature of index investing is its greatest strength. Index funds are not about getting rich quickly. They are about building wealth steadily year after year. By staying invested and letting time work its magic, investors see their money grow. This slow and steady approach is ideal for those who want reliable results without the stress of constant trading. The real advantage of index funds is simply staying invested. Instead of trying to beat the market, index fund investors participate in its growth. This participation, combined with patience and discipline, leads to steady wealth accumulation. Staying in the market is often more powerful than trying to outsmart it. Trying to time the market, buying low and selling high, is extremely difficult. Even experts rarely get it right. Index funds avoid this challenge by staying invested at all times. This removes the stress of guessing and lets your money grow naturally with the market. Index fund investing is all about the long term. Short-term market movements are unpredictable and often irrelevant to your overall success. By focusing on decades rather than days, investors can ignore the noise and stay committed to their goals. This perspective is key to building lasting wealth. Patience is essential for index fund investors. Markets will fluctuate, sometimes dramatically, but those who remain patient and stay invested benefit from the market's overall growth. Patience allows compounding to work and helps investors avoid costly mistakes driven by emotion. During market downturns, many investors panic and sell their holdings. This often locks in losses and prevents recovery. Index fund investors avoid panic selling by staying committed to their plan. This discipline helps them ride out tough times and benefit from eventual recoveries. Market hype can be tempting. News stories about hot stocks and big winners create excitement and fear of missing out. Index fund investors ignore this hype, focusing instead on their steady, reliable strategy. By tuning out the noise, they avoid risky bets and stay on track. Index funds allow you to participate in the overall growth of the market. Instead of betting on individual companies, you benefit from the collective success of many businesses. This participation is simple, effective, and proven to build wealth over time. Index funds typically have lower fees than actively managed funds. This means more of your money stays invested, compounding over time. Lower fees are a hidden advantage that can make a big difference in your long-term returns. Many index funds offer automatic investing options. This makes it easy to stay consistent, adding to your investment regularly without needing to make decisions each time. Automatic investing supports discipline and helps build wealth steadily. You don't need to be a financial expert to invest in index funds. Their simplicity makes them accessible to everyone, regardless of experience. This democratizes investing and allows more people to benefit from market growth. Overtrading can erode returns through fees and poor timing. Index fund investors avoid this by sticking to their plan and minimizing unnecessary trades. This helps preserve wealth and keeps the focus on long-term growth. Managing an index fund portfolio is simple. There's no need to constantly monitor individual stocks or make frequent adjustments. This simplicity saves time and reduces stress, making investing more enjoyable and sustainable. Emotional mistakes like panic selling or greedy chasing can ruin investment plans. Index funds help investors avoid these traps by providing a steady, unemotional approach. This leads to better outcomes and more reliable wealth building. Markets always recover from downturns, though it may take time. Index fund investors benefit from these recoveries by staying invested. This patience ensures they capture the market's eventual growth and avoid missing out on rebounds. Fear of missing out, FOMO, drives many investors to chase trends and make risky bets. Index fund investors avoid FOMO by sticking to their steady strategy. This helps them stay focused and avoid unnecessary risks. Index funds deliver steady returns over time. While there may be periods of volatility, the overall trend is upward. This reliability makes index funds a favorite for long-term investors seeking predictable growth. Picking individual winners is hard and risky. Index funds eliminate this challenge by owning a piece of many companies. This approach ensures you benefit from the market's overall success, not just a few lucky picks. Index funds are accessible to everyone, regardless of wealth or experience. This inclusivity allows more people to participate in market growth and build wealth over time. It's a simple, democratic approach to investing. Active trading can be stressful with constant decisions and market monitoring. Index fund investing removes much of this stress, offering a calm, steady path to wealth. This makes investing more enjoyable and sustainable for the long run. Index funds focus on participation, not prediction. By owning a slice of the market, you benefit from its overall growth. This simple approach removes the pressure to guess and lets you enjoy steady progress. Greedy chasing of hot stocks can lead to losses and disappointment. Index fund investors avoid this by sticking to their steady plan. This discipline helps them build wealth without unnecessary risks. Index funds offer reliable growth over time. While there are ups and downs, the overall trend is positive. This reliability makes index funds a trusted choice for those seeking steady wealth accumulation. Index fund investing requires little action. Once you invest, you can let time and the market do the work. This hands-off approach is ideal for busy people who want to build wealth without constant effort. Trying to predict the next big winner is stressful and often unsuccessful. Index funds remove this pressure by offering a simple, steady path. Investors can relax and focus on their long-term goals. Wealth accumulates steadily with index funds. By staying invested and letting compounding work, investors see their money grow year after year. This slow and steady approach is proven to deliver results. Index fund investing is simple and effective. There's no need for complex strategies or constant monitoring. This simplicity is its greatest strength, making it accessible and reliable for everyone. The real advantage of index funds isn't trying to beat the market, it's simply staying in it. By participating in the market's growth and avoiding risky bets, investors build wealth steadily and reliably. Index investing is about patience, discipline, and participation. By spreading risk, staying invested, and focusing on the long term, investors see steady growth. It's a simple, proven strategy that works for everyone, regardless of experience. In the world of investing, ordinary often wins. Index funds may not be exciting, but their steady, reliable approach delivers results. By avoiding emotional mistakes and sticking to a simple plan, investors build lasting wealth. Letting time work is the key to index fund success. By staying invested and allowing compounding to build wealth, investors see steady progress. Time, patience, and discipline are the foundation of this strategy. Index funds offer a simple, steady path to wealth. By participating in the market, staying invested, and avoiding emotional mistakes, investors build reliable, lasting wealth. The real advantage is not trying to beat the market but simply staying in it and letting time do its work.